Welcome to the research desk.
Glad to be here.
So I want to take you back to February 23rd, 2022.
Okay.
BP had this 19.7% stake in Rosneft, right? The Russian state-owned energy giant.
Right. A massive piece of their global portfolio.
Exactly. I mean, it was considered a crown jewel, and it had been meticulously modeled. I mean, every discounted cash flow projection, every cost of capital calculation, every margin forecast, all of it was mathematically optimized on a spreadsheet in London.
The absolute epitome of traditional capital efficiency.
Precisely. But then, literally 72 hours later, they were forced to exit.
Just completely wiped out.
Yeah. They eventually took a roughly $25 billion write-down. $25 billion.
Wow.
And the thing is, that capital didn't degrade over a 10-year business cycle. You know, it didn't underperform. It simply vanished.
Overnight.
Overnight. So today, we are dissecting a question that is quietly keeping every corporate board and institutional investor awake at night. Basically, in a nonlinear world, does disciplined capital allocation still create value? Or has survival itself become the first positive NPV project?
It is the defining question right now. And to really set the authoritative, intellectually honest tone for today's briefing, I mean, we have to ground ourselves in the foundational insight from our source material.
Go for it.
Because it captures the stakes of that BP story perfectly. It states verbatim, quote, "In a disruptive era, the relevant unit is no longer just value creation under normal conditions, but value preservation and option creation under abnormal ones." End quote.
Right. Value preservation and option creation. And look, my position on this core clash is pretty clear. I argue that traditional capital allocation frameworks, specifically the time-tested Giroux principles, they remain a decisive source of advantage.
Really? Even after the BP example?
Yes, absolutely. If we just redefine the variables for a harsher world, I mean, the framework isn't dead. It just needs a software update.
Well, I come at it from a fundamentally different way.
I figured you would.
Yeah, look, the traditional spreadsheet models are structurally flawed for today's environment. Geopolitical shocks, nonlinear technological shifts, they completely invalidate the foundational assumptions of priceable risk.
You don't think you can just adjust the risk premium?
No, I don't. You cannot run a software update on a system when the hardware underneath it has literally caught fire.
Okay, well, the tension between those two views is exactly what we are going to unpack today.
Let's hear it.
To understand what happens to a capital allocation playbook that was, built for relatively stable markets when the world starts behaving nonlinearly, we have to establish the shared reality.
Right. The ground truth.
Exactly. We are looking at an era defined by heavy sanctions, severe supply chain fragmentation, aggressive industrial policy, and obviously an artificial intelligence arms race.
A massive arms race.
Right, so the traditional definition of what makes a balance sheet optimal is just under absolute threat. But before we get into the mechanics of our disagreement, let's establish the common ground here.
Which is that capital allocation still matters.
It matters enormously, arguably more now than ever. Mistakes today don't just, cause a quarterly earnings miss. They compound faster and far more violently than they did a decade ago.
They absolutely do. And the reason they compound so violently is that geopolitical risk has moved. It used to be mere background noise, right?
Like a standardized footnote in a 10K?
Exactly. Just a boilerplate sentence about macroeconomic uncertainties. But now,
it is a first-order input, and the evidence is staring us right in the face.
Give me the macro view.
If you zoom out from single companies like BP and just look at global macroeconomic flows, the UNCTAD World Investment Report 2023 showed global foreign direct investment fell 12% in 2022.
Wait, let's pause on that, because I want to make sure the listener really understands the gravity of that number.
Yeah, it's huge. Foreign direct investment isn't just stock market trading. It's not paper.
Exactly. FDI's physical capital. It is a corporation in Germany deciding to build a physical factory in Brazil, or a U.S. tech giant building a massive data center in Ireland.
Right. It's the physical manifestation of global economic integration.
So when global FDI falls by 12% in a single year, I mean, that isn't a cyclical market fluctuation. That is the physical unwinding of globalization.
The maps are literally being redrawn.
Right. It is geopolitical strains severing traditional capital flows. The traditional financial models assume capital flows freely to wherever it can achieve the highest risk-adjusted yield. But the UNCATD data proves that capital is now hiding behind sovereign walls.
Yeah, seeking safety over efficiency.
You can be entirely right about your market demand, entirely right about your operating margins, entirely right about your financing costs. But if the political map changes overnight, you are left holding a stranded asset.
Okay. I see why you emphasize those extreme discontinuities. The physical world is indeed fracturing. I won't argue that. But let's anchor this theoretically in what capital allocation actually does.
Sure.
We know from Obuson and Callahan's 2014 paper,
Oh, the classic one.
right, Capital Allocation, Evidence, Analytical Methods, and Assessment Guidance, published in the Journal of Applied Corporate Finance. We know from that paper that intelligent allocation remains the central driver of long-term per-share value creation.
I agree with their premise for a stable world.
Let's think about what they prove, though. A CEO basically has 5 choices with the cash their business generates, right?
Reinvest, acquire, pay down debt, dividends, or buybacks.
Exactly. Reinvest internally, acquire other companies, pay down debt, issue dividends, or buy back stock. Mauboussin and Callahan demonstrated that a rigorous analytical approach to those 5 choices is the ultimate differentiator of corporate success over decades.
Right, but
That foundational truth hasn't evaporated just because the map is fracturing.
the mechanism of evaluating those 5 choices has completely broken down.
See, I argue it hasn't broken. It has mutated.
Mutated how?
Yes, AI and geopolitical risks absolutely break simple, static hurdle rate logic. If you are just blindly asking your spreadsheet, does this project yield 10% when our cost of capital is 8%, you are going to get slaughtered.
Completely slaughtered.
But the real debate we are having today is whether the classic framework can adapt to these extremes, or if it entirely collapses under the weight of fat-tailed outcomes.
Those rare but catastrophic events.
Right, like a sudden war or a sweeping technology embargo. I firmly argue that the framework survives. This is my bull case for financial rigor. The Giroux principles are upgraded, not broken.
Okay, I'm listening. But I need you to explain the actual mechanics. How exactly do you upgrade a mathematical model that relies on smooth, normal, bell curve distributions when the physical real world is handing you step function breaks?
You do it by recognizing that optimal capital structure is no longer a static mathematical point.
What do you mean by a point?
Historically, corporate treasurers learned that optimal capital structure was about finding the exact perfect ratio of debt to equity.
Right, the mix that minimized their weighted average cost of capital, the WACA.
Exactly. That is usually cheaper than equity because of tax shields, right? So the old logic was load up on just enough debt to lower your overall cost of capital, but, not so much that you risk bankruptcy.
It was a single point on a graph, a delicate balancing act.
But today, that optimal capital structure must be viewed as a zone of flexibility. You aren't managing to a decimal point anymore. You are managing a buffer. We have to think of the balance sheet as a strategic weapon rather than just a container for financing.
The balance sheet as a strategic weapon. I mean, it's a great phrase.
It's the reality.
But what does it actually look like in practice? Because I'll be honest, to a traditional activist investor, a quote-unquote zone of flexibility just sounds like an excuse for management to hoard cash and destroy return on equity.
Oh, they definitely complain about it.
But it looks exactly like Apple.
Apple.
Yeah, let's look at the concrete evidence. As of Q4 2023, Apple was sitting on more than $160 billion in cash.
A massive pile.
Now, if you look at that through a narrow, traditional spreadsheet lens, that cash appears wildly inefficient.
Oh, absolutely.
Because cash sitting in short-term instruments might yield 4 or 5%, while Apple's core business generates a return on invested capital that is, frankly, exponentially higher.
Right. An old-school corporate rater would look at that and say, distribute that cash immediately. It's dragging down your aggregate metrics.
Exactly. But in a world of trade wars, localized manufacturing mandates, sudden policy barriers, that $160 billion isn't idle cash. It is an optionality reserve. It's geopolitical insurance. Okay, but is it actually insurance or is it just the luxury of a monopoly?
I don't think you can separate the two.
I think you have to. Apple hoarding $160 billion isn't necessarily proof of an upgraded Giroux principle. If you're an institutional investor listening to this, you're probably screaming at your dashboard right now thinking, well, Apple can do whatever it wants because they own the iOS ecosystem.
They have a moat, sure.
Right, but a mid-cap industrials company, they cannot hold a massive proportion of their market cap in cash without getting brutally attacked by activist hedge funds.
They might get attacked, but
When you call it an optionality reserve, it sounds brilliant. But from a purely analytical standpoint, cash sitting idle is a drag on returns, and most companies will be heavily penalized for it.
they will be penalized by investors who are stuck in the peacetime paradigm. But the market is learning to price this resilience.
You think the market is rewarding inefficiency?
I think the market is redefining efficiency. Take ASML as another example.
Okay.
In late 2023, they traded at an approximate enterprise value to EBITDA multiple of roughly 40x.
40 times EBITDA? That is a staggering premium.
Right, especially for a company that makes manufacturing equipment. So why is the market willing to pay $40 for every $1 of operating earnings?
Because of their monopoly on UV.
Exactly. Because their extreme ultraviolet lithography tools, these massive microscopic mirror systems that are literally required to print the world's most advanced microchips, they are entirely indispensable. They have a global monopoly on the choke point of the modern digital economy.
Sure. They are the bottleneck.
And their competitive indispensability fundamentally changes their financing resilience. Valuation is inherently dynamic. This is a concept firmly supported by Wilcox in his 1990 paper from the Journal of Accounting, Auditing, and Finance.
Remind me of the title.
A synthesis of security valuation theory and the role of dividends, cash flows, and earnings. Wilcox proved that value isn't just about mechanically discounting next year's cash flows. It's about the optionality embedded in the firm.
Look, I don't disagree that ASML has an incredible moat, but I think you are conflating operational dominance with capital allocation framework survival.
How so?
Let's go back to your premise that excess capital is now a strategic weapon. You're arguing that holding inefficient capital is actually highly rational defensive positioning.
It is simultaneously defensive and offensive. That is my second point in this upgraded framework. Excess capital is most valuable when it buys resilience and positioning, because disruption doesn't just destroy opportunities.
It shifts them around.
Exactly, it reallocates them.
Okay, give me an example of disruption reallocating opportunity in a way that traditional models can actually capture.
Look at industrial policy, look at the CHIPS and Science Act in the United States.
Right, the subsidies.
It fundamentally changed the return profile of strategic capital expenditures. Suddenly, building a localized semiconductor plant isn't just a massive expense, it's heavily subsidized by the state to ensure national security.
Okay.
If you have that zone of flexibility on your balance sheet, you can co-invest with the government and capture that market share. Or look at the data on cybersecurity.
What about it?
The global cybersecurity market is projected to grow from $172.9 billion in 2023 to $266.2 billion by 2028.
That's a massive jump.
Massive. Now, an old-school CFO might view a huge increase in cybersecurity spend as a pure deadweight cost, right?
A drag on operating margins.
Exactly. But in a nonlinear world, that capital deployment is offensive. You are buying protection, yes, but you are also securing operational redundancy. That allows you to capture market share when your less resilient competitors suffer a catastrophic ransomware attack and go offline for 3 weeks.
I'm sorry, but I just don't buy that the traditional models handle this well.
Why not?
Because the traditional models treat cybersecurity as an expense to be minimized, not an asset to be capitalized. But okay, let's follow your logic. You're saying the tools of capital allocation, like capital expenditures, M&A, buybacks, they still work?
Exactly. Traditional tools still work if they are used strategically rather than mechanically. Let's talk about mergers and acquisitions.
Okay, M&A.
M&A is not dead. The objective function has just shifted from cost synergy to capability acquisition.
Give me a historical case.
Look at Google's 2014 acquisition of DeepMind.
Oh, that's a perfect example.
Right? They bought a company with essentially zero near-term cash flow, a strict near-term DCF model, would have rejected that deal instantly.
Laughed it out of the room.
Google was buying future positioning and platform acceleration. They were buying the smartest AI researchers on the planet. Similarly, look at Microsoft's 2023 $69 billion deal for Activision Blizzard.
Wait, Activision Blizzard?
Yeah.
That's a video game publisher. I mean, how does a video game publisher fit into an argument about geopolitical resilience and AI optionality?
Because the architecture of modern AI and spatial computing overlaps heavily with high-end gaming environments.
Oh, I see where you're going.
Microsoft wasn't just buying Call of Duty revenue streams. I mean, they were buying a massive, highly engaged user base, proprietary gaming cloud infrastructure, and interactive 3D modeling capabilities that feed directly into their broader enterprise and consumer AI ambitions.
It was a massive defensive moat.
It was a $69 billion deployment of excess capital to secure the perimeter of their platform. And on the other side of the capital allocation menu, look at share repurchases.
Buybacks?
Apple's $90 billion buyback authorization in 2023 proves that a company can return massive amounts of capital to stabilize their shareholder base while simultaneously investing heavily in frontier R&D.
Right.
The tools, M&A, buybacks, CapEx, they all still work. The scoring system has just changed to prioritize optionality over immediate yield.
Look, elegant financing means absolutely nothing if you can't actually build the product.
What do you mean?
Upgrading the framework sounds fantastic in a spreadsheet, but it completely falls apart in the physical world. And this brings us to the operational realities of the bear case.
Okay, let's hear the bear case.
The spreadsheet is not a shield. I want to systematically dismantle the idea that you can just widen the variables and carry on.
Dismantle away. Where does the math break?
It breaks at the very foundation. The assumption of continuous risk. My first point is that geopolitics creates binary risks, and traditional finance is structurally incapable of handling them.
Structurally incapable?
Yes. Traditional finance, specifically the models you were defending, assumes risk is smoothly priceable. It assumes that if a project is riskier, you simply raise the discount rate.
Right, you adjust the WACC.
You estimate the variance, you price it into the cost of capital, and if you hold enough different assets, you diversify the specific risk away. But state actions redraw the distribution entirely.
But isn't that just a matter of magnitude? If I know a jurisdiction is highly volatile, I demand a 20% hurdle rate instead of 10%.
No, it is a matter of kind, not magnitude. We already mentioned BP's roughly $25 billion Russia write-down.
Yeah, the zero.
Exactly. It went to zero. No amount of debt-to-equity optimization, no zone of flexibility could offset a sovereign shock that instantly vaporized that asset to zero. You cannot diversify away a geopolitical block.
That's a fair point on expropriation.
Look at the U.S. export controls on advanced semiconductors to China instituted in October 2022.
That was a massive shock to the supply chain.
Massive. Or the earlier sweeping restrictions on Huawei. If you were a Western tech supplier, these weren't normal business risks that widened a probability curve. They were sovereign state actions that severed your access to your largest customer overnight.
It literally became illegal to sell to them.
Exactly. How do you plug illegal into a WACC calculation?
Well, you model the probability of trade restrictions. We have political risk analysts for a reason.
You can model a probability, sure, but you cannot model the magnitude of a zero. When a revenue stream goes to literal zero, the 3% risk premium you collected on your margin for the 3 years prior doesn't even come close to covering the multi-billion-dollar hole in your balance sheet.
It's a wipeout.
And history warns us that these aren't isolated incidents. The 1973 oil crisis, the 1979 Iranian Revolution, these are historical proofs of sudden capital entrapment.
That's true.
Imagine being a corporate planner in 1978, modeling your Iranian oil infrastructure. Your spreadsheet told you it was a highly accretive asset. Months later, a revolution occurs, the assets are expropriated, and your peacetime assumptions become historical artifacts in a matter of hours. A spreadsheet cannot shield you from a revolution.
Okay, I acknowledge the severity of an expropriation, but I would argue that those binary events, while devastating, are edge cases. They don't invalidate the day-to-day utility of measuring capital efficiency.
But the edge case is now the baseline operating environment.
Is it, though?
Absolutely, and that transitions perfectly to my second point. Operational bottlenecks absolutely nullify your financial elegance.
Let's talk about the bottlenecks.
You talked earlier about the CHIPS Act and deploying capital defensively. Let's look at the physical reality of doing that. The U.S. Department of Commerce released a report in 2022 showing that more than 70% of global semiconductor manufacturing capacity is concentrated in East Asia.
70%.
Over 70%. That level of concentration means geopolitical disruption doesn't just cause a temporary pricing fluctuation. It produces complete operational paralysis.
Which is exactly why companies are allocating capital to reshore and nearshore supply chains. They are recognizing the risk and acting rationally.
But look at the cost of this so-called resilience. Let's break down the mechanics. To build a leading-edge U.S. fab today costs upwards of $20 billion.
It's an astronomical sum.
And more importantly, it takes 3 to 5 years to build. You cannot fast-track curing concrete and installing EUV lithography machines.
No, you can't.
And this isn't isolated to tech. The International Energy Agency's World Energy Outlook 2023 makes a parallel point for energy transition. When war forces you to fundamentally reconfigure your supply lines, as Europe had to do with Russian gas, you are looking at years-long, massive, capital-intensive rebuilds.
Right, the LNG terminals.
Exactly. Furthermore, we have credible macro estimates showing that shifting these global supply chains could raise underlying production costs by 40 to 60%.
A 40 to 60% cost increase is staggering. Yes.
It's more than staggering. It physically breaks a discounted cash flow model.
Walk me through why you think it breaks it.
Let's explain why to the listener. A DCF model values a company by projecting its cash flows for the next 5 or 10 years, and then calculating a terminal value for everything after that.
Right, the perpetuity value.
That terminal value often makes up 60 to 80% of the entire valuation, and it relies heavily on the assumption that the company maintains a steady-state profit margin into perpetuity.
Okay.
If your core manufacturing costs suddenly and permanently spike by 60% because you had to move your supply chain from Shenzhen to Ohio, your profit margin collapses.
Sure.
When the margin collapses, the terminal value is mathematically obliterated. In a world where costs spike like that, capital is no longer a flexible growth resource you can strategically deploy. It becomes a compulsory, emergency payment just to keep the lights on and stay alive.
Well, I don't disagree with the mechanics of the DCF breakdown. If margins compress, terminal value drops. That's math.
Right.
But I would argue that if the objective function of the corporation shifts from pure, unadulterated efficiency to long-term resilience, these high costs aren't failures of capital allocation. They are the new standard of prudence.
Prudence?
Yes. Paying a 40% premium to ensure you actually have the microchips needed to put in your cars is a highly rational, positive NPV decision when the alternative is halting your global production lines completely, like we saw automakers do during the pandemic.
Rational for survival, perhaps, but it completely breaks the traditional metric of shareholder value creation. You're no longer creating new value, you are just paying a massive ransom to preserve old value.
I see it as preserving the option to create value tomorrow.
Well, that leads directly to my third bear case point, which moves from geopolitics to technology. AI payoffs are far too nonlinear for traditional capital alternatives to capture.
How so? I just gave you the Google DeepMind and Microsoft Activision examples.
You cited M&A as a tool. Let's look at the actual timeline of M&A. A traditional responsible M&A process in a Fortune 500 company takes 12 to 24 months.
From initial due diligence to closing?
Right, from due diligence through regulatory antitrust review to actual operational integration. In the foundational AI space right now, 12 to 24 months is a geologic eternity.
The models change every 6 months.
Exactly. By the time your corporate development team actually integrates the acquired startup, the underlying model architecture is obsolete. The key research talent has vested and left to start their own firm, and the market has entirely repriced the software category.
So you are saying the friction of legacy corporate governance is incompatible with the velocity of AI development?
Exactly. And we have academic theory to back this up. Clayton Christensen's 1997 book, The Innovator's Dilemma, perfectly articulates this exact mechanism.
Remind us of the core thesis.
Why do massive, well-funded, highly profitable incumbents fail when a disruptive technology arrives? It isn't because they are stupid. Christensen proved they fail precisely because they apply rational, legacy capital allocation processes to discontinuous problems.
They do what they are taught to do.
Right. The traditional WACC model tells the CEO, don't invest in this early-stage AI tool. The margins are terrible compared to our legacy software, and the market is unproven. So they pass.
Which opens the door for the disruptor.
Buybacks and dividends during a technological discontinuity are highly suspect for this exact reason. They reward the existing shareholders today with cash while quietly starving tomorrow's protective moat.
You know, the tension here is genuinely fascinating. You're looking at the severe friction of reality, the 24-month M&A timelines, the $20 billion fab costs, the 40% margin hits, and you are concluding that the financial models are fundamentally broken.
Because they are.
But I am looking at that exact same friction and concluding that the models simply need to be recalibrated to a harsher reality.
It's a tough gap to bridge.
It is. To really understand this paradigm shift and bridge the gap between our views, we need to rely on the conceptual models and analogies outlined in our briefing. These vivid storytelling frameworks ground the dense financial theory we've been debating, and they are absolutely vital for corporate boards trying to intuitively grasp how to navigate this.
Let's weave them in because they do clarify the stakes. Let's start with ship design.
Ship design. Okay.
If you are building a commercial vessel, traditional capital allocation is like designing a hull to be as light and fuel-efficient as possible for sunny, calm weather. You minimize drag to maximize profit.
Makes perfect sense.
Cargo actually reaches the port. That is what capital structure must become, a hull designed for a storm.
That aligns perfectly with my argument for the CHIPS Act and reshoring. Yes, the Ohio fab is the heavier hull. It costs more, but it survives the geopolitical storm.
Exactly.
Another crucial analogy from the briefing is ecology. How does nature achieve resilience?
Not through a monoculture.
Right, not through a single, static mathematical optimum, but through diversity, redundancy, and connectivity. Think of traditional supply chain efficiency as a monoculture crop. Say, a massive field of identical corn.
Hyper-efficient.
It is hyper-efficient, easy to harvest, and incredibly profitable, right up until a specific blight or pest arrives, and then it wipes out the entire yield in a week.
A total zero.
A corporate structure built for the nonlinear world needs to operate like a rainforest. It appears inefficient and chaotic, but its redundancy makes it incredibly robust against systemic shocks.
And sometimes the most sophisticated financial advice circles right back to classic kitchen wisdom.
Don't put all your eggs in one basket.
The briefing explicitly highlights the oldest rule in the book. Don't put all your eggs in one basket. It sounds elementary, almost childish, but it is devastatingly relevant to the exact concentration risks we've discussed. Look back at BP.
The $25 billion egg.
They literally put $25 billion worth of financial eggs in the Russian sovereign basket, assuming the political climate would remain a stable refrigerator.
And the basket dropped.
The basket dropped.
Moving from the geopolitical to the technological, another framework addresses your exact critique of AI investment. Woodworking tools.
Oh, I like this one.
Using traditional retrospective capital allocation tools to fund an AI transformation is like using legacy carpentry tools to build the intelligence layer of a smart home.
Right.
A traditional DCF model is a hammer. It is an excellent tool for building a physical factory where you know the exact cost of lumber and the expected rental yield. But if you were trying to program the automated predictive climate control system of the house and you swing a hammer at the motherboard,
You destroy the system.
you don't just fail to build it, you destroy the system.
Exactly. You cannot discount cash flow your way into a neural network breakthrough. The timeline is too unpredictable. Which brings us to the fifth analogy, chess.
Chess?
Corporate strategy used to be a linear race, run as fast as you can in a straight line. Now it is dynamic optimization. A grandmaster playing chess doesn't plan for a single linear set of moves. They don't say, I will move my knight, then my bishop, and then I will win.
They plan for continuously branching adversarial paths.
Yes. If the opponent blockades the center, they flank. If a geopolitical rival embargoes a critical mineral, the corporation must immediately pivot to an alternative chemistry. It requires capital to be staged and ready for multiple, contradictory futures.
And finally, forest cultivation. Traditional finance constantly asks how much fruit a specific tree is going to yield next quarter.
And if it doesn't yield,
If the tree doesn't produce, the spreadsheet says to cut it down and return the capital to shareholders. But foundational AI and advanced materials research require immensely long gestation periods.
Decades, sometimes?
It is like growing a forest from saplings. You are cultivating an entire ecosystem of talent, compute infrastructure, and proprietary data. Short-term payout logic fundamentally misreads the physical reality of frontier investment. You can't force a redwood to grow faster by aggressively optimizing its quarterly water intake.
Those analogies are beautiful, and they intuitively explain why the math has to change. But they bring me to the critical, highly underexplored insight of this entire debate, what our briefing identifies as the wild card.
The wild card?
And I truly believe this is where corporate boards fail the most catastrophically, even when they actually understand the theory. The wild card is this: financial optionality is not organizational optionality.
Let's stop and unpack that distinction deeply. What exactly is the difference between financial optionality and organizational optionality? Because I think this is where our two perspectives actually begin to converge into a practical solution.
I will define it practically. A company can have a flawless, pristine balance sheet. They can hold abundant cash, let's say $10 billion, in a dedicated reserve.
Okay.
They can maintain exceptionally low debt leverage. They can perfectly set aside capital specifically marked for AI integration or supply chain reshoring. And they will still fail spectacularly.
Why, if they have the cash ready to go?
Because the actual bottleneck in a crisis isn't financing, it's managerial absorption capacity.
Managerial absorption capacity. Explain what that physically looks like when it breaks.
It looks like institutional paralysis. A massive war chest of cash does absolutely nothing to ensure successful reshoring if your operations team has spent the last 20 years outsourcing everything and literally doesn't know how to navigate local environmental permitting in Ohio versus Taiwan.
Right. The institutional muscle memory is just gone.
Exactly. If your HR department is incapable of hiring and evaluating the 500 specialized lithography engineers needed for that new fab, your $10 billion sits there doing nothing.
Or take AI.
Right, a board can bravely announce a generous pause on share buybacks to fund a $2 billion AI transformation.
But that money doesn't magically create an innovation culture if your internal governance structure still requires 4 layers of committee approvals to deploy a new software model.
Moving at the speed of a 1990s conglomerate, in disruptive, non-linear eras, a failure in capital allocation is as much an organizational design problem as it is a treasury problem. You cannot just buy adaptation if your culture violently rejects it. That is an incredibly sharp point. Having the capital to buy the most powerful chess piece on the board means absolutely nothing if your executive team literally doesn't know how the piece moves.
Precisely.
The organizational culture is the underlying operating system that the capital allocation software runs on.
It really is. So, having rigorously dismantled the extremes of both sides today, the naive, blind application of a static spreadsheet on one hand, and the complete terrifying paralysis of binary unpriceable risk on the other, we actually arrive at the synthesis.
The path forward.
We are testing exactly how corporate boards must practically evolve tomorrow morning. I maintained from the beginning that the framework survives, but I concede to you that it must heavily mutate. Based on our source material, the briefing outlines a specific 4-part mutation for corporate finance.
Let's lay out the mutation.
First, optimal capital structure must become fundamentally resilience-aware. It transforms from a simple math equation aimed at a single leverage target into a complex buffer design problem under the threat of fat-tailed shocks.
Buffer design. Got it.
Second, excess capital transforms from being viewed as a drag on returns into being valued as strategic optionality. Third, transformative AI investment can no longer be evaluated like a mature, predictable business line. It must be treated as a real options portfolio.
Which solves the timeline issue.
Exactly. And fourth, entirely validating your wildcard point, capital allocation must be judged holistically across both financial readiness and organizational capability. The traditional framework only truly fails when management teams mistake fragile efficiency for robust durability.
Which brings us directly to the exact practical implications.
We have 7 incredibly detailed mandates for how boards must operate in this new era. Let's debate them organically.
I'm ready. Let's dissect them meticulously, because the devil is entirely in the details here. If we get the implementation wrong, this whole conversation is just academic poetry.
True.
Implication number 1 mandates that boards redefine optimal as a liquidity and leverage band rather than a single target.
Right. You have to permanently replace single-point WAC targets. And the standard for this new band is mathematically rigorous. Boards must stress test their balance sheet against a very specific scenario: a greater than 5% sustained decline in global trade volumes for 2 consecutive quarters.
A 5% decline in global trade for 2 quarters is a massive macro shock. That implies severe port closures, synchronized tariffs, or a hot war in a major shipping lane.
Exactly. It isn't a gentle recession, it's a systemic fracture. If your debt covenants are breached and your liquidity evaporates under that specific macro stress test, then your capital structure is definitively not optimal, regardless of how beautifully efficient your WAC calculation looks during peacetime.
That leads naturally to implication 2, which is where I demand the most discipline. Implication 2 is separate idle cash from the optionality reserve.
The discipline factor.
I have been highly skeptical of cash piles throughout this debate because lazy management loves to hoard cash and call it strategic. So the discipline here is paramount. Boards must explicitly and legally specify the exact triggers for the use of that reserved capital.
They can't just let it sit there vaguely.
No. Management must answer. Are we holding this $5 billion specifically for distressed M&A if a competitor goes bankrupt during a supply shock? Are we holding it to rapidly build out sovereign AI infrastructure if compute access is restricted? Are we holding it for emergency supplier relocation if sanctions hit?
They need a plan.
If the management team cannot define the specific trigger condition, it is not an optionality reserve. It's just idle cash dragging down equity returns, and it should be returned to shareholders.
That level of strict accountability is essential. And implication 3 directly addresses your earlier concerns about the friction between legacy models and technology. Stage AI investment like a real options portfolio.
Yes.
We agree you cannot force foundational, discontinuous AI bets through a standard, mature business hurdle rate. The mechanism of a DCF will kill the innovation. So the directive here is to use milestone-based funding over extended 3 to 7 year horizons.
Explain real options for the listener because it's fundamentally different from traditional NPV.
Sure. In traditional net present value, you try to forecast all the cash flows for the life of the project on day 1. If the NPV is positive, you fund the whole thing. If it's negative, you kill it.
Very binary.
But a real options approach acknowledges massive uncertainty. You don't fund the whole 7-year AI project up front. You make a small, initial investment, buying the option to play the game. After year 1, you look at the landscape. Did the technology progress? Yes. You exercise the next option and unlock the next round of funding.
And if it failed?
You abandon it with minimal loss. The metrics of success change completely in those early years. You don't judge the project on its near-term earnings per share contribution. You judge it on talent retention, commercialization progress, and how well the new technology fits into your broader ecosystem.
I support that, provided the milestones are actually enforced, which flows into implication 4, and this is where investors need to get ruthless. Discount payout-heavy firms that underinvest in adaptation.
Ruthless is the right word.
We need to be aggressively, mathematically skeptical of companies executing massive share buybacks if those buybacks coexist with a weak cybersecurity posture or heavily concentrated, fragile supply chains.
Let's visualize that. If you are a CEO authorizing a $2 billion share repurchase to juice your stock price, while simultaneously relying on a single vulnerable choke point in East Asia for 70% of your critical physical components.
You are committing corporate malpractice.
You aren't creating long-term shareholder value. You are harvesting the stable past while completely abandoning the volatile future. The market should heavily discount your equity.
Conversely, implication 5 provides the blueprint for who the market should reward. Prioritize moat-backed flexibility.
Who gets the premium?
Investors should favor companies with demonstrably strong competitive positions, wide moats, that maintain low net leverage, and strong free cash flow, and crucially, who visibly reinvest that cash flow into supply chain localization and core R&D. We want companies that fund their own heavy armor.
Which brings us to implication 6, the actual mechanics of geopolitical underwriting. We have to underwrite geopolitical exposure at the granular asset level, not just the generalized country level.
It has to be specific.
Very specific. The concrete indicator provided in our briefing deck is exactly that. Analysts and boards must flag any reliance on a region that holds over 70% of the manufacturing capacity in a critical input chain.
That 70% threshold is the literal red flag. Whether it's rare earth minerals, advanced semiconductors, or active pharmaceutical ingredients, if 70% of global capacity sits in one geopolitically sensitive zone, that concentration requires immediate capital allocation to diversify.
Right away.
And it requires it regardless of the near-term margin hit. If diversifying drops your gross margin by 400 basis points, you take the hit, because the alternative is a binary 0.
And finally, implication 7 brings us back to your wild card. Audit organizational optionality. The practical checklist for a board here is unforgiving. You don't just look at the treasury.
You look at the people.
You look at the company's historical acquisition integration track record. Do they actually extract value from the companies they buy, or do they destroy them? You look at post-deal talent retention. Do the brilliant engineers they acquire stick around, or do they flee the corporate bureaucracy after 12 months?
Usually they flee.
Exactly. You look for definitive operational proof that their AI strategy isn't just performative messaging designed to inflate the stock price for Wall Street algorithms.
You have to audit the culture as rigorously as you audit the cash flow.
I look at this entire sweeping practical synthesis. We've taken the abstract theory of Giroux and battered it against the brutal realities of geopolitics and AI, and I am drawn back to the most profound analogy that concludes this core portion of the research desk's briefing. It is the concept that anchors this entire paradigm shift: survival as the first positive NPV project.
Survival as the first positive NPV project. It is a beautiful contradiction in traditional financial terms, and it forces a complete, foundational rewiring of the executive brain.
Exactly. Let's explain why it's a contradiction. NPV, or net present value, is usually calculated by projecting future cash flows and subtracting the initial investment. If the result is greater than 0, the project adds value to the firm.
Right, it creates new wealth.
Survival doesn't generate a new cash flow. It just stops an existing cash flow from violently ending. But in a nonlinear world, avoiding a fatal 0 is mathematically identical to generating a massive positive return. If your company doesn't survive the geopolitical storm, your beautifully modeled 20% return on invested capital projections for year 5 are completely, utterly meaningless.
Let's bring this all together. We've traversed the foundational theory of capital allocation, the stark geopolitical reality of severed capital flows, the brutal physical and operational bottlenecks of rebuilding supply chains, and the structural mutations required to upgrade modern corporate finance.
It's been a journey.
The overarching bottom line is unambiguous. Keeping the firm alive, culturally adaptive, and strategically dangerous when normalcy vanishes is the new imperative.
Keeping the firm alive is the prerequisite for keeping it profitable.
And my final reflection on this material is that the nuanced answer we've arrived at through this debate is not to abandon financial discipline.
Which was your initial stance, or close to it?
I started this briefing deeply, fundamentally skeptical of the old spreadsheet models, and I remain absolutely convinced that blindly plugging linear inputs into a peacetime DCF is an act of corporate malpractice today. But the solution isn't to worship the old discipline as infallible, nor is it to discard it in favor of chaotic, instinct-driven spending.
So what is the solution?
The solution is to evolve financial discipline into a rigorous, mathematical practice of resilience. Survival is no longer what happens before value creation begins. It is the first, most critical value-creating investment a board can make. There is no declared winner in our debate today, but rather a united understanding of a permanently, physically altered corporate landscape. The era of easy, fragile efficiency is officially over.
The financial models must bend to physical and political reality, not the other way around.
This has been a rigorous, unvarnished examination of what it actually takes to deploy capital when the map of the world is constantly being redrawn. This is the Research Desk officially signing off.